project that we're going to look at today is based on it's based on a project here in Orlando. It's not a project that I worked on personally. It's not a project that anyone that I'm very closely associated with has worked on personally. But it's a project that has caught my eye over the last couple of years, just because of how unique it is, and it generated a monster sale value when it sold last year. And it was in the midst of a lot of challenges going on in the market, from a capital markets perspective, and despite all that, it performed really well. It continues to perform really well today for the new owner, and just wanted to take a look at what the original developers might have been thinking when they were looking at this piece of land and saying, yes, this is the place that we want to develop. This is the kind of product that we want to put here. So we'll dig in and take a look at that. So high level, when starting a development project, this is a step that's missed by a lot of people. Sometimes you want to get into the numbers and dig in on that side and just see what the model spits out. But it's really important to look at the site itself and get an idea of what's already there and what uses might complement what's already there and all that good stuff. So coming in to the Google Maps view, so this is the project. This is the project that got built here. It's called the Ellington at Oviedo Park, here in the northeast side of Orlando. Northeast side of Orlando, there's a lot going on here. In a lot of ways, it's a growing area. It's not the highest growth portion of Orlando, but there's a lot going on here, and people enjoy living here, working here, and being entertained in this area. And so, this particular parcel, it's on a hard intersection, and you've got 1, 2, 3 lanes going south. Looks like you've got 2 lanes going north with 2 left turn lanes and a right turn directly coming into this site. I actually don't know, if this retail was built prior. It looks like it was older than this property, so I would imagine that this retail is already here. So you have some curb cuts in here coming into this general area. Right turn in here, there's a Chick-fil-A. You've got a Bank of America ATM here, and you've got some lower use retail in this car care, auto repair shop, auto parts, pet store. The only really good thing that you have going on for this area is this Chick-fil-A on the hard corner. The rest of it is kind of lower use. Coming down south of the site, you've got more direct access into the back end that cuts up north. You've got what looks to be more lower use retail, not the most exciting stuff. You've got a strip mall down here with a Publix and a Planet Fitness, and some better uses down here from retail, so that's good. Generally, pretty easy access. You've got a major state road 417 running north south here, that connects into the rest of Orlando pretty easily. So that's good. Good for people that have to commute to downtown to go to work. Yeah, so I mean, it's got some positive attributes about it. It's got some negative considerations to it. Doesn't look like there's a lot going on in the immediate area, but the access is decent. And so that's high level, just the general location. From an employment standpoint, again, pretty easy access into downtown. This particular area is less than a half hour from downtown. You've got the University of Central Florida here directly south of the site, so that's going to be a big employment pool. You've got an Advent Health fairly close. Oviedo is generally more student and younger population, so that makes it kind of interesting. Yeah, several Publix and retail places around. So high level, I'd give the site a grade of a B probably. It's not amazing, but it's decent. So after I would go and look into the site, I start plugging in some basic details into the model and see if it's worth taking a look into. So name the project, the address of the project, city and state that it's in. Start date, we'll say that we're going to close on this land in 4 months. I'll zoom in here a little bit. In October of this year. We're going to start construction 6 months after we close. Maybe we're still working through some entitlements or some planning that we have to do after we close on it. We'll start going vertical 4 months after we start construction, and then the final certificate of occupancy will be 18 months after we start construction. So we'll start leasing here 2 years or 24 months after we've closed on the land. It'll take another 13 months to stabilize the property or to get it to 94% occupied. And then we're saying we're going to sell it 3 months after stabilization. So high level, that would be like basic timeline. So how do you come up with a timeline like this? Part of it would be prior experience of the developer. Usually, when you're building a community that's this large, you've probably done a few projects. To the extent that you haven't, that's totally fine. Having a conversation with a general contractor or other developers in the area would help to give some idea of relevant timeline. And a lot of that is really based on the size of the project. So I'll get into the unit mix in a second here. I guess we can go ahead and move into that. That's probably appropriate now. The unit mix of this property. So when deciding what's the appropriate unit mix here, how many one beds do I put in, 2 beds, 3 beds? Do I want any studios? Do I want any unique units? Et cetera, et cetera. A lot of that is going to come from market research, right? Looking into the existing submarket and the broader market and seeing of the one beds that are available in the market, how many of those are occupied? If the one beds are 98% occupied in a given market, that's probably a good indication that the market wants more one beds. Same thing goes for any other unit type. So letting the market guide the unit type can be helpful. Sometimes there's zoning restrictions or future use restrictions that require a certain percentage of floor plans as a part of the total development. So it's just important to look into the particular municipality and see if there are any restrictions like that. For this unit mix, we're just pulling the exact unit mix from the Ellington, and I have CoStar access, so I can do that pretty easily. I can just come into CoStar and look at the Ellington. And for those not familiar, CoStar is one of the data aggregators and providers in the commercial real estate industry that is very helpful in digging into lots of particulars on commercial real estate. So the Ellington, you can come into its unit tab, and you can see exactly what are the bed and bath counts of each of the floor plans, their average size, the number of units on that floor plan, how many of those units are currently available, and what those units are currently renting for. So the Ellington is telling us that it only has 1 and 2 bedroom units. So I'm going to label those accordingly in here. Based on vernacular that I'm familiar with, you could just call these, like, I don't know, 1 bed 1 or 1 bed 2 or whatever, but it's pretty common for the 1 beds to be labeled with the letter A, the 2 beds with the letter B, 3 beds with the letter C, and so forth. So I dropped the unit mix into here with the associated unit counts, their unit square footage, and the amount that they're renting for. And then at this point, I would come into the other income section. Other income is kind of an interesting one. If you're operating property in your local area, you kind of know what you're going to operate your property like and what kind of other income you can expect. If this is a new market for you, I think the best thing is just talking with local property management at the surrounding properties and just kind of see what they're doing. Is it normal to charge back for utilities? Is it normal to charge a fee to get residents back into their unit if they lost their key, or if they did something to damage the unit or whatever? Valet trash. What other fees are you earning income on? So that's the other income section. Some other income that is common here, especially in the Orlando market, is to have like detached garages that people can rent out, so they can have a private garage that's on site, and those usually go for 175 to 250 a month for those garages. So some people choose to develop those. Some communities have storage units built into the actual buildings. So if you're on like the 3rd floor, there could be like 2 to 20 storage units on that floor, and you might pay something like 50 to 95 a month to rent out that private storage. So that way you don't have to go to a storage facility. You could just have that there. Those storage facilities usually aren't huge. Some communities do have larger ones, but usually those are like like 5x5 closets. They're not like the 10x20 storage units that you would see at a separate storage facility. And then I would come down and I would take a look at operating expenses. So on the operating expense side, I'll get into real estate taxes specifically here in a second, but generally for everything else, the best way to do this is to go to CoStar or whatever data provider that you have. CoStar just happens to be pretty good at this. And we're going to want to look for multifamily properties that, let's say they're at least 50 units. I'll zoom out here a little bit. And then properties that have CMBS debt on them are required to report their financials back to the agencies. And so CoStar is able to get that loan information and the associated financials. And so you can come on here and you can look at properties that have an active loan on them and they include their financials. And let's say that we want to look at stuff that is only Class A or Class B. We want to look for stuff that is newer than 2015. So we're able to put all these filters on here, and particularly in the Vito market, there's nothing. But you can look kind of in the surrounding markets and look at some of these other projects, and you can come and click into them and get their associated financial statements, and it'll have the financial statements for that particular property, and then you can look at it per unit, and you can kind of get an idea of what properties in the market are operating at, and use those as your assumptions if you don't have active properties that you're already operating in that market, or you don't have an idea of what to do in that market. So these items, they vary broadly, particularly things like utilities. This is reporting a gross number probably. Some properties report a net utility number, meaning net of RUBS or net of billing back to the residents. So it's just good to make sure you know what you're looking at. And that gives a lot of very helpful information. So I would do that for something like 7 to 10 properties in the market. Maybe you need to broaden your reach and say, well, I need to go back to 2010, or hey, I need to include Class C or whatever, and get an idea of what those properties are operating at in the area. If you're still not able to get great data on everything, the next best thing is to contact brokers in the market that are actively marketing new construction properties. And often you can get onto their OM distribution list and get some data out of there too. So after we've gone through and looked at some of those comps, or we've talked with brokers, gotten a good idea of what those operating expenses are, and we input those here. And then those operating expenses have a certain assumption tied to them of how much of that cost is fixed versus how much of it is variable. So what that means is on new construction, we're going to go through a lease up, right? We're starting from 0 occupancy and we're trying to get to 94% occupancy. Well, through that process, maybe things like utilities, we're not going to incur all of that cost day one when the project opens, but maybe we think, when we start leasing, utilities are going to be 65% fixed. And then as we increase occupancy, once we get over 65% occupied, then we're going to incrementally increase the cost of utilities up to this $1,200 per unit per year. And same thing with everything else. On real estate taxes, the reason that this gets a little bit more nuanced than the other operating expenses is because there's phases at which taxes get reassessed depending on the municipality that you're working in, and so it's important to try and account for those different assessment periods. So generally speaking, you'll have 3 assessment periods: one for acquisition, when you close on the land. So that's going to be your taxes rolling forward for a little bit. In between acquisition and stabilization, you're going to have your taxes be assessed at the cost method, which is essentially every year or every 6 months or whatever, depending on the municipality that you're working in. you're going to get incrementally reassessed based on your construction costs. And usually the municipality is going to have some kind of reporting mechanism whereby you report what those costs are and where you should be reassessed at. So it's really important, especially during that phase, to work with a good tax consultant that can help in that process. Once the project has been built, gone through leasing, gone through its lease up, got to stabilization, it's going to get reassessed again based on the market value at that time. And then once you sell the asset, you'll get the next buyer is going to make an assumption about how they're going to be assessed based on based on the market value at that time, which is going to be your disposition value. So you have these three stages of getting assessed. The tax rate comes from your county, and then we're making an assumption that the tax rate is growing with your expense inflation rate in this model. So growing your tax rate at expense inflation helps to keep your disposition value lower. So why would you want to keep your disposition value lower? Well, a development project has so many things that can go wrong. So keeping those like general assumptions that you really can't control conservative, like your disposition value, is very helpful in in outperforming your performance. So that is something that you could go in and change, right? You could zero out the expense growth rate and make this tax rate the same, but that's just how I've defaulted the model to be. It's one of those things that helps keep your underwriting conservative. So gone through our operating expenses. We're saying that on an untrended basis, we're operating this property at about $10,000 per unit per year is the operating expense load. After we've gone through our income items and our operating expense items, next we would take a look at financing. So most projects are going to be financed with a construction loan. Some projects don't. Some projects like to finance all equity, but I've provided space in here where you can put in your construction financing. Some developers like to sell it right after they stabilize, and therefore don't need permanent debt. But some developers, like to hold on to their assets because it's generating, that above market yield because of it being a development project instead of a straight out acquisition. So if they want to hold on to it and they know that they're going to take out their construction debt with more permanent financing, which should be more favorable, then there's space in here to put in permanent financing. On the disposition assumptions side, I like to value different components of real estate differently, just because that's most likely how the market is going to do it on the back end. Especially when you get into more sophisticated institutional space, you'll most often see it to where if there's an apartment component and then there's a retail component or even add on a self-storage component or whatever, usually they're going to break out those cap rates and associated values into different increments. And so I've provided a space to do that too. So those are the project assumptions for the apartments, both on the operations side and on the financing side. The financing actually covers the whole project, but the revenues and expenses up here are just for the apartments. On the retail side, what I would do next is I would come into the retail side and, based on how you've assessed the site and, you've come to decide that, hey, the retail in this area isn't that great. I'm sure that was probably the developer's thought process when they were going through this originally is, hey, there's only a Chick-fil-A here. Our residents could really benefit from some ground floor retail. So they decided to put in some ground floor retail. And you go in and you do your market research and you find out, based on talking with 3 leasing brokers in the market, we think the ground floor retail tenants will pay $40 per square foot per year. And we think that they can support 3% annual rent increases. So you'd come in and you make those assumptions into your retail. And most retail and most commercial is going to be 100% triple net, meaning that they will pay their portion of their operating expenses. To the extent that that's not true, maybe maybe after you're talking with your leasing brokers, you find out, oh, well, shoot, actually, the retail tenants don't pay for their operating expenses. We as the landlord are responsible for that. Then you would make that change here and just zero this out, or maybe they're only reimbursing a portion of it, etc. I'm not going through a lot of the like technical side of the model because I did that in a previous walkthrough where I kind of walked through like the ins and outs of this particular model. If you have any questions about kind of the guts of the model, then you're welcome to watch that video. It's on my YouTube channel and it's on my website. So after looking at the operations on both the apartments and the retail side, this is a space to input your construction budget. So these assumptions here are general market assumptions for Orlando and for this particular pocket. This is going to vary based on the developer and based on their capability, but this is sort of in range for what a developer would expect in this area. So that gets us to, and there's a lot of information here that I'll just close up real quick. That essentially gets us to this summary over here, where our land is going to be about 30,000 a unit, hard costs about 166, soft costs of about 48. So total project costs of about 72.5 million, and that's split across apartments and retail accordingly. So after I've gotten all of my operating assumptions plugged in, my construction budget plugged in, it's really at this point that you could start to look at return on cost and just see if the deal makes sense, right? You have your IRR and you have your equity multiple and you have these other metrics that are helpful and useful, but really a development project boils down to why does any developer build instead of buy? They build because you should be able to get a yield premium on your construction relative to what you could do if you just bought the same property on the open market. So this project is saying, hey, we would like to have a 75 basis point yield spread on our multifamily, but actually right now, based on our costs and based on our revenues and operating expenses, we actually think we're only going to generate 65 basis points. On the retail side, the retail is actually looking pretty attractive. So two things there. One, can we get our construction costs down, and how? If we get our construction costs down, does that sacrifice the resident experience on the back end, so much so that we need to lower our rent assumptions? And same thing on the retail side. Are we being like overly optimistic about what we can achieve from a rental rate standpoint? Have we done our research properly? We think so at this point. So the retail's looking good. It's just what can we do on the construction cost side to not sacrifice resident experience, but still make this a good and attractive project. So then I would probably come into the construction budget and just take a look at it again, walk over it with my general contractor, say like this is what I have to achieve in order to make this project work. What can we do? Maybe the contractor can say, well, you're putting in you're putting in this really nice clubhouse with really maybe you're putting in really nice amenities into it. Maybe your gym is really souped up, or instead of touching the gym, maybe your decorations that you're putting in there, maybe you can cut back on those, or the material that you're building with. Maybe you're putting stone onto the exterior, and maybe you could get away with siding, or basically you walk through it with your general contractor and you take a look at the scope that he had put together for you originally, or she had put together for you, and you come to it and you say, okay, well, we think we can shave maybe $3 a foot off of that number. So instead of 117.50, you end up with 114.50. And based on what you talked about with the contractor, it doesn't sound like anything would really sacrifice the resident experience. So you don't think you have to make any changes on the revenue side. So you come back over to your return on cost and you see, shoot, you're so close. Is there anything else that we could do? And maybe you go in and you look at your market research again and you say, well, our market cap rate we had at 5.5. This particular project, and this is one of the reasons why I chose this project, it sold for, I want to say, something like a 4.25 or a 4.5 about 9 months ago. And this is in the middle of all of the crazy stuff that all of us have been dealing with, and it was really impressive. We still want to be conservative on our assumptions, but based on the project's performance, we think that there's at least a quarter basis point that we can shave off in our apartment cap rate. So we pull that down a little bit, and then we come back to our return on cost, and we're saying, based on this spread, we think the apartments can generate a 6.2, and the retail can generate an 8. So blended, we're getting to a 6.25 at the project level, and our market cap rate is about a 5.35 when it's blended across both of those, and that feels pretty good based on what we're seeing in the market. So, I mean, ideally, you'd like to have this spread be larger, especially with what's going on in the capital markets right now, and there's so much uncertainty and everything. But this feels pretty good. It feels good enough to at least say, okay, this deal is past screening. Let's dig into it a little bit more. Maybe we can go back to the seller and say, we need a little bit more margin here. We need to decrease the land price. Maybe the contractor is being overly conservative in their assumptions, and they can shave off a few more dollars. There's always places that that you can find dollars. The important thing is to not get overly aggressive in the wrong places, right? All of the places that we've talked about are things that you can actually go in and have an influence over. The market cap rate, obviously there you just you need to operate conservatively as you can. But as developers, you're trying to build a building, and so you always have to find that balance of what's the right number to put in there that's going to get this project done, but still has a very high probability of achieving our underwriting, and are we leaving enough meat on the bone to outperform that? So those are the places that I would really start with a deal. And assuming that all of those things kind of pass go, right? We've got our operating revenues in there, our operating expenses, we've got our construction costs. That gives us this return on cost metric, gives us a place to kind of dig in and be thoughtful about what we're building and when we're going to build it. Are we going to be able to deliver it on time, and all of these things? The next thing that I would look at is our project level returns. So I'll zero out this sensitivity table here real quick, because this is value basted. It's not very dynamic. So I'd come in and look at my project level returns, and I would say, okay, over a 40-month hold, so just over 3 years, based on everything that we've done so far, we should be able to return about a 19% to our. We should be able to generate a 19% at the project level, and to our investors after our waterfall, we should be able to generate about a 16.5. Equity multiple to the investors of about a 1.56. So then it would be a matter of having a conversation with investors, whether that's discretionary or non-discretionary funds, and saying, hey, here's the project. I've put this together, and I tried to go through and walk through some particular details, but obviously we've been able to do this over over a 40-minute call together. So in a matter of a half hour or an hour, you've taken a relatively complex development project and you've synthesized it into something that's very digestible, both for you internally and for your investors. Then it'd be a matter of getting their approval. So that's how I would walk through the screening of a development project. If you have any particular questions about this model in particular, or about other items that I would dig into, more than happy to stay on the call together today and answer any of those questions. But thanks so much for being on here with me.